For the first time, Fannie Mae just announced their latest housing market forecast through 2026. And by the way, they downgraded their forecast for home sales next year, and also a big increase in their forecast for mortgage rates next year as well. I have a lot to share in today's video. Let's go ahead and start. This is, of course, from Fannie Mae. It says, of note this month is a revision to their inflation outlook to reflect core inflation readings. Basically, that strips out volatile energy and food prices because those prices can vary quite a bit. So based on core inflation readings coming in modestly hotter than expected, we now expect near-term core inflation to be somewhat higher compared to their previous outlook. And because of this, they actually upgraded the forecast for mortgage rates through 2025. They go on to say the following. We have also upper revised their mortgage rate outlook given the rise in bond rates, the mortgage-backed security market. Since the September Fed FOMC meeting, we now project mortgage rates to end 2024 will be at 6.6%. That would be the average 30-year fixed rate for the entire year this year. It was previously at 6%. And to be at 6.3% by the end of 2025. Their previous forecast just 1 month ago was calling for rates to be at 5.6%. So higher for longer, to say the least. And also at the end of this video, of course, I'm going to talk about this forecast, what it means for you as a home buyer, if you're looking to buy a house in the next couple of years, or for people who are real estate agents or loan officers like myself. So because they upper revised their forecast for rates, it says this in turn was the primary driver of a meaningful or a significant downward revision to home sales over the next couple of years. Also, corresponding to this higher mortgage rate environment and a lower sales home forecast, we have also downward revised their single-family mortgage originations outlook. Total single-family mortgage originations are expected to be at $1.64 trillion this year. Previously, it was at 1.67 trillion. Then 1.94 trillion next year. The previous forecast was calling for 2.14 trillion, but then increased to 2.4 trillion in 2026. They also notice this following. Existing home sales, which of course excludes brand new home construction, existing home sales are now expected to rise by only 4% next year from the 2024 pace, which is more or less on track to be nearly a 30-year low. Actually did some research on this. Their forecast at just over 4 million sales next year is technically, or would be technically, a 3-year high. However, it's not a big increase, and therefore it is still very close to being at a 30-year low based on their forecast of 2025. The downward revision to their home sale outlook, which was previously forecasted to rise by 11% in 2025, now it's only increased by 4%, is a result of a significant upward movement in rates and other long duration bonds in recent weeks. Whereas previously, this group from Fannie Mae had expected mortgage rates to dip below 6% in early 2025. The revised forecast now shows that rates will end next year at 6.3%, quite a bit different compared to the forecast just posted 1 month ago. And also get this, they're also predicting that rates will be above 6% in 2026, which is all contributing to their forecast of home sales decreasing or barely squeaking out a gain over the next couple of years. However, Fannie Mae does expect a significant improvement of home sales of around 17% in their 2026 forecast as affordability conditions improve, the lock-in effect weakens, and pent-up demand to move materializes. Now, why are they predicting that mortgage rates will be higher for longer? And it says this right here. Long-run interest rates have moved upward over the past couple of months following a string of continued strong economic data and disappointing inflation readings. That's according to Fannie Mae's Senior Vice President and Chief Economist. So for example, I did some research on this. The Fed's key measure of inflation, that's their PCE or core PCE, which again strips out volatile energy and food prices, has grown higher compared to the previous year in the past 2 out of the past 3 months. This all means this is not a good environment for the Fed to cut rates greatly because inflation has been winding up for 2 of the past 3 months. All right, let's break this down because I want to share their forecast for all these metrics, looking at housing starts, home sales, home prices, mortgage rates, and much, much more, which again is through 2026, the first time they announced this forecast. Let's first talk about single-family housing starts. A housing start is a beginning phase or the beginning phase of the construction of a brand new house. So single-family housing starts is to rise by 6.2% this year compared to last year, then to decrease in 2025 down by 1.2%, then to rise by 5% in 2026. Let's have a look at their forecast for new single-family houses. So they're calling for that to increase by 5.7% this year compared to 23, then to rise by 7.2% next year, then to barely squeak out again, up by 4% in 2026. So for existing houses, this includes home sales for single-family, condos, and co-ops. That's going to decrease by 2% potentially to be at just over 4 million home sales. You know, a small decrease compared to last year's figures. And last year, by the way, was a 28-year low. So it's pretty remarkable. We're going to be lower than that potentially. I also believe this as well compared to last year, even though we're at a multi-level or multi-decade level low. Then to rise by 4.2% next year, and then a giant increase up by 17.1% in 2026. A couple of things really caught my attention is that starting in Q3 of 2025, they're calling for home sales to increase every single quarter. So to end 2026 at 5.156 million, that'd be a little bit higher than the long-run average. Every year, the median number going back to the late 1980s is around 5 million. So long-run average is around 5 million home sales, which is normal. Obviously, much lower than what we have been seeing over the past few years at around 4 million based on the forecast next year and this year as well. Another thing I want to mention as well is that they actually downgrade the forecast for home sales big time next year. So their new forecast is calling for just under 4.2 million existing home sales in 2025. However, their forecast just posted 1 month ago was calling for just over 4.5 million sales next year. And again, the big reason why they actually downgrade their forecast is because they now believe that mortgage rates are going to stay higher for longer. Let's talk about that. Let's first talk about actually home prices first though. So their HPI, which is their home price index, they're calling for prices to rise by 5.8% this year compared to last year, then to rise by 3.6% in 2025, then a small gain only up by 1.7% in 2026. There's a few things that really catches my attention regarding their forecast for home prices, and let's start with this right here. They're calling for a decrease every single quarter from Q4 this year through at least Q4 of 2026. However, still higher compared to the previous year. In other words, not calling for home prices to decrease on a year-over-year basis. Therefore, they're calling for a deceleration of home prices over the next couple of years. So in fact, looking at this, by the way, 6.7% is Q1 of 2024 compared to Q1 of 2023. But every single quarter thereafter, they're calling for home prices to decrease every single quarter through at least Q4 of 2026. So for example, we're going to end the year in 2026 up by 1.7% compared to Q4 of 2025. This 1.7% increase in Q4 of 2026 is also quite a bit lower than the 5.8% they're forecasting in Q4 this year. On top of that, that gain of 1.7% is quite a bit less than the historical average. Historically speaking, home prices tend to increase in the range of 3 to 5% and not less than 2%. Here's also something that really caught my attention as well that you guys should be aware of as well. So this 3.6% gain in 2025 for home prices was also the forecast posted 1 month ago. But what happened 1 month ago? Let's read on. This is my own comment though. This does not make sense to me that this was not revised downward, because they're now calling for mortgage rates, or the average mortgage rates in 2025, to be at 6.4%. 1 month ago, back in October, they were calling for rates to be much less than that at 5.7%. So my question for Fannie Mae is, why are they predicting that home prices will still rise by the same amount next year, up by 3.6%, if they believe that mortgage rates are actually going to be higher than their forecast 1 month ago? They're now calling for the average rate next year to be at 6.4%, whereas 1 month ago, their forecast was only at 5.7%. So speaking of that, let's have a look at that. So 1 month ago, again, 5.7%. Now they're calling for the average rate next year to be at 6.4%, and also to end the year of 2026, also above 6% as well, at 6.1%. Therefore, starting in Q1 next year, they're calling for rates to decrease very slowly until we hit around 6.1% in Q2 of 2026 and hover at that same rate through the end of the year. So to summarize that, they're now predicting that rates are going to be above 6% every single quarter through at least Q4 of 2026. Okay, let's change gears slightly here and talk about my forecast for home sales and much, much more, and how this compares to years past. So the forecast for home sales of existing houses, again, to be at 4,010,000. That'd be a decrease of 2% compared to 2023, and down by a whopping 25% from 2018 and 2019. At just over 4 million sales, this is actually lower than the forecast posted 1 month ago. They're calling for 4,060,000 sales. Now it's just over 4 million. On top of that, this is much lower than the forecast posted 3 months ago. 3 months ago, they're calling for 4.13 million sales. In my opinion, these downward revisions are likely from the big increase in mortgage rates that we saw back in October. Rates increased by approximately 80 basis points in October, which is a pretty significant increase, going from a 1.5 year low to about a 2-month high by the time we hit end of October. Also at 4,010,000 home sales, that would be not only lower than last year at 4.09 million, but it would also be the fewest amount of home sales since the year of 1995. In other words, a 29-year low of home sales this year. I actually think that's very, very close. My predictions is also calling for around 4 million sales this year as well. Lastly, this is also approximately 1 million fewer than the long-run average of 5 million sales. So the median number per year since 1989, based on my nerdy formula, this, by the way, is according to NER, these figures, is at 5 million. So we'd be missing approximately 1 million fewer transactions this year compared to the long-run average. So big picture, the US population is much higher today than it was, of course, back in 1995. And of course, there's a lot more houses right now as well, right? So per the US Census Bureau, there's approximately 50 million more people living in the United States in 2020 compared to the year of 2000. However, we're going to be at the same relatively low level of home sales this year compared to 1995. Based on this information, how does this impact our housing market? A low level of transactions puts upward pressure on inventory levels as houses take longer to sell and as houses are still being listed for sale. So a lack of transactions causes upward pressure on inventory levels. Let's talk a little bit more regarding that. I also added this as well. Zillow's forecast is also calling for 4 million transactions. That was posted a couple of days ago, or about a week ago. Also, my forecast, which I have been telling you guys for months now, is also around 4 million transactions. So here's my advice for you guys, whether you're a home buyer or an agent or a loan officer. If you are a home buyer or want to buy a house, maybe next year, a low level of transactions could translate into higher inventory next year. If inventory in your area, in which you want to buy a house is very high, write some insulting offers. Try to get a good deal. Of course, every housing market's different, so learn your market in order to figure out how to write a aggressive offer. So for example, if you're looking to buy a house in Austin, Texas, parts of Arizona, parts of Florida, for example, they have a glut of houses for sale. You can write an offer probably far below asking price. If you are looking to buy a house in an area that has a high amount of home buying demand, a lack of houses for sale, of course, you have to tailor your offer based on the conditions. So, right, every market's different. So definitely learn your market in order to kind of figure out how to write a great offer. If you are a real estate agent or a loan officer, I would say this right here. Despite mortgage rates being around 7% virtually all year, there are still 4 million transactions that actually occurred. That is a low level, but even though we had elevated rates, we still had around 4 million transactions this year. So my advice for real estate agents and loan officers watching today's video is to try to get a larger share of a smaller amount of transactions that potentially could last through 2025. With that said, I appreciate you guys so much for watching today's video. If you guys want a real estate agent referral, please check out my website, which is realestateteamfinder.com. I have a lot more things coming to YouTube and other social media channels as well. Maybe I'll make a separate video regarding that based on my goals for 2025. In any case, thank you so much for watching today's video. I appreciate you. Please like and subscribe, and we'll see you in the next video.